Hello and welcome to The Upside. I'm Kyle Sharapata. Are politics in Canada and the US dominating your news and social feed? Does this have you a bit overwhelmed, worrying about your investment portfolios? Well, you're in the right place. Today, we're discussing politics in your wallet, helping you stay a step ahead. Today, we'll learn about how Fidelity's portfolio managers are thinking long-term and finding opportunities to protect and grow your hard-earned savings. Tariffs have dominated headlines. They've been on, off, delayed, threatened. It's been a whirlwind. Here's Ilan Kolet, institutional portfolio manager on Fidelity's global asset allocation team, with more on the impact of U.S. tariffs on the Canadian economy, interest rates, and the group's current positioning.
It's important we discuss the proposed tariffs coming from the U.S. on Canadian exports. Any significant tariff would push Canada into a recession, or would very likely push Canada into recession. Canada is already in a fairly vulnerable state. We've had very little growth since the start of 2023. We have households that are far more indebted than they should be, and that debt is intersecting borrowing rates that is going to be renewing at a higher rate than where it originated. And the tariff risk, in our view, really just presents an additional layer of exposure to the downside that Canada can't really afford to weather at this moment. Now, there's a lot of uncertainty. We don't know when, how, where, or even if these tariffs will occur, but it's something we should be thinking about, and we're positioned for the potential downside. Again, we've had a fairly cautious view on Canada for some time now, and a lot of that is expressed through a meaningful underweight to the Canadian dollar. One of the ways that we build in resilience into our portfolios is by being underweight the Canadian dollar. In the event of a Canadian dollar depreciation, which we've certainly seen lately, our portfolios get hurt less, and we preserve basis points for our end investors. Again, a really critical position and way that we can build in some downside protection and a shock absorber into our portfolios. So one of the things we need to talk about is right now we are optimistic and overweight equities, specifically in the US. Oftentimes we talk about the downside protection that we have in our funds, right? And the cautious view that we have around Canada and the protection that we're building in with our underweight to the Canadian dollar. But we shouldn't forget that right now we are optimistic and overweight, particularly in the US, in the US equity market. What we're witnessing in the US, in our view, is perhaps a 2 or 3 times in our lifetime productivity expansion, right? This is something we discussed a long time ago and we're positioned for last year, but we're seeing very strong rates of growth, slowing inflation, a Fed that's normalizing, a healthy labor market, and really strong equity returns. And if we layer on an additional layer of deregulation and sort of pro-growth policies, we expect this to really continue. And we're positioned for it accordingly. We're overweight US equities, and we've broadened that allocation to include more of the equity market rather than just the large cap equities. In other parts of the world, we're a little bit more cautious, right? So again, a protectionist approach will certainly have important implications for overseas markets and as well as Canada, where again we're more cautious and defensive in Canada and much more muted positions overseas. So that overweight to equities really is focused in the US. And again, we're optimistic and we're meaningfully overweight equities. And if you have any other questions or you want to dig into more of these questions in even more detail, please check out our Q1 thought leadership paper titled 11 Questions into 2025, available now on fidelity.ca.
Jurrien Timmer, Director of Global Macro at Fidelity, is a regular guest on our Fidelity Connects webcast, which is live daily for financial advisors, but then available for all on replay as a video podcast. Jurrien here took an audience question asking if there is a chance February's stock market volatility could influence the Trump administration's decisions on implementing the tariffs. Take a look.
A couple of questions here coming in, so let's see if we can get a couple of them to you. Do you think that the market volatility will cause President Trump to pause his tariff discussions? We hope.
Not at this point.
Okay.
So obviously Friday was a big down day, but the market is not really that volatile yet, right? So you look at credit spreads, very well behaved. You look at the equity risk premium, still at about 3.5%, bottom 10th percentile. You look at the VIX, it's at 15 or so. So if I were the president and I'm just looking at a screen of the major indices, like I'm not really seeing that much to be alarmed about, which I think gives him license to keep going. And so I think the White House or the cabinet is correctly focused on long-term rates, because that really, to me, is the main indicator, right? Because if the term premium rises and it pushes long rates up to 5 or above, you have a fiscal mess, because you gotta pay for all the debt that's already out there and the debts that still to come. And then you have the risk-free asset really competing with the equity markets for return. So keeping that yield down, I think, is sort of the main thing. So maybe they'll look more at interest rates or long yields than they do at the stock market, knowing probably correctly that one is going to drive the other. And I think the stock market is just, they've seen this movie before, right? The last time. The world didn't end, which doesn't mean it's not going to end this time. But I think the market is just kind of, they're buckled up, they're on the roller coaster, they know it's going to be a bumpy ride, and everyone is sort of crossing their fingers.
As Canadians, we've been focused on everything happening at home: the impact of potential tariffs on Canadian consumers, the growing Buy Canadian movement at stores, and a changing political landscape, to name a few. But let's focus on Europe. Canada's next big trading partner? Trump's next target? Maybe both. Tom Stevenson, Fidelity International Investment Director and respected financial news writer, joined Emily Ananuevo recently for his boots-on-the-ground perspectives from London. Let's take a look.
Thanks so much, Tom, for joining us today. Now, from your perspective, what is the current state of Canada-US relationships right now? And ultimately, how can this affect Canada's relationship with Europe?
So one of the interesting side effects of the changing relationship between Canada and the United States might be a deepening of ties between Canada and the European Union. Reducing Canada's dependence on the US as an export market is likely to be a priority in future, and the EU is an obvious starting point for that rebalancing. 25% tariffs are threatened by the US on imports from Canada, and now on imports from the EU too. And so there's never really been a better time for the two to explore a deeper relationship. And Prime Minister Trudeau was in Brussels only a couple of weeks ago, exploring expanded cooperation in critical sectors like minerals, clean energy, technology. And Europe's friendship with Canada is already the oldest formal relationship the EU has had with any industrialized country. It started in 1959. And the two economies got much closer together 10 years ago when they signed a comprehensive economic and trade agreement, and also a strategic partnership agreement. So Canada and the EU are building on pretty firm foundations. So let's just put some numbers on that. The EU market is Canada's second largest global trading partner for goods and services. And it's the second largest partner for two-way direct investment after the US. Trade in goods and services between Canada and the EU was worth about $157 billion in 2023. Canada has made direct investments into the EU worth about $290 billion. And Canadian companies employ more than 250,000 people in their affiliate companies in EU member states. And meanwhile, in the opposite direction, EU companies have invested $158 billion in Canada. That's more than 11% of the total direct foreign investment in Canada. And EU companies employ about 400,000 people in Canada.
That sounds fantastic, Tom. Now, lastly, what is your market outlook now that we're over 2 months into the year?
One of the interesting conclusions from the first 2 months of 2025 is that Donald Trump's America First approach to international relations should not necessarily be read as a Wall Street first investment outcome. In the last 3 months since the US presidential election, the S&P 500 index has basically moved sideways, while the Stock 600 index of European shares has risen by an impressive 18%. The UK market has also outpaced the US, and even China is looking investable again. And that wasn't the central case of many investors as they contemplated what Trump 2.0 might mean for markets. The consensus view was that Trump's tax cuts, deregulation, tariffs, immigration curbs would be a positive for US economic growth, and that would translate into a positive backdrop for US stock markets. America first looked like meaning rest of the world second. And initially it was just that, but the glass half full view of Wall Street has shifted. Investors are now more focused on the potential downsides of the transactional Trump trade doctrine. The spotlight is now on the negatives of tariff retaliation, and particularly on the inflationary impact of trade restrictions. So recently, the US has seen a drop in consumer confidence, higher inflation expectations, a cooling in the housing market, and the first contraction in service sector activity in 2 years. Meanwhile, over here in Europe, earnings expectations ticking up. The end of the war in Ukraine is in sight. The ECB is cutting interest rates, and the new two-party coalition in Germany following last weekend's general election is looking to increase spending, notably on defense. So one of the unexpected positives from America's apparent retreat from the transatlantic alliance has been a greater sense of collective cooperation in Europe. So 10 years after Brexit, it looks like the region is pulling together as it hasn't for many years. Another conclusion from the strong performance of Germany's more extreme parties, both on the right and on the left, has been the likelihood of increased fiscal spending to improve the lives of the many people who, frankly, have felt left out by the traditional centre-left and centre-right parties that have controlled German politics since the Second World War. That spending boost is another reason why European markets look more attractive to investors. So for me, the big lesson from the past 3 months is the importance of diversification and the need to keep an eye on where the value is in global markets. It's impossible to predict how markets will react to the changing political and economic landscape in the short term. But one thing that was clear 3 months ago was the relative cheapness of European shares compared to those listed in America. The timing of Europe's catch-up with the US was unpredictable, but history suggested that it was always likely to happen at some point. Timing turns in the market is impossible, but holding a well-diversified portfolio ensures that we can benefit from these shifts when they do happen.
Well, that was great. Tom always has such interesting perspectives, and he'll actually be joining us again on Fidelity Connects in a couple of weeks for a full 30-minute interview. So advisors, keep an eye on your inbox to register for that, and investors, please subscribe to the Fidelity Connects podcast so you don't miss an interview. So Emily also sat down with KY Wong, an equity research analyst who covers US travel and leisure. We're into March, and that means winter breaks from school and lots of travel to warmer destinations. But have the tariff threats and comments from south of the border about making Canada a state impacted Canadians' travel plans this winter? And have US travel destinations and companies taken notice? Here's Emily and KY with more on that topic.
KY, thank you so much for joining us today and sharing your insights on the ongoing tariff story. Now, your research covers US, specifically travel and leisure. From your observations, KY, what has all this political noise and the tariff uncertainties, what have you observed in terms of travel and leisure specifically?
Yeah, particularly for travel, the biggest noise is that Canadians are boycotting US travel. And one company, WestJet, did talk about the impact. They mentioned there was a 25% drop in demand of traveling from Canada to US. So this is pretty significant. Other companies did not talk about it. And if you look at that 25% drop in demand, is actually from both leisure and business. leisure travelers are reducing their travel to the US because of the boycott, but business travelers as well, because they are looking at the tariffs, trade war, they're not sure when it will end. So a lot of those businesses are putting their business proposal, business plans on hold. And so in reaction, some of those airlines are adjusting their capacity, reducing the capacity of flying from US to Canada, Canada to US.
Right. So we are seeing some impacts on, like you mentioned, leisure travelers and business travelers. Now that tariffs are on the table and then off the table, they're having significant impacts in Canadians going to the US. Can you speak specifically on the tariff uncertainties on Canadian companies versus US companies?
Yes, indeed. So in this trade war, my heart is with Canada. I actually just became a Canadian citizen 4 months ago. So that's
Oh my gosh, congratulations.
Yeah, thank you. So my heart is with Canada in this
Right,
war.
of course, yeah.
And unfortunate thing is that Canada will be a bigger loser than US. I mean, the Canadian companies versus US companies, because for the US companies, for example, that I spoke to, they're only talking about around low single digit of their revenue coming from Canadians tourists visiting the US.
Right.
So it's pretty immaterial. And if you are talking about 1% impact, 1% revenue exposure, and 25% impact, that gives you around 0.25% impact on their revenue. That's not that much. On the other hand, the big impact would be on the Canadian companies, particularly travel agents, because they're a larger percent of exposure of their revenue is coming from Canadians traveling from Canada to US.
What observations do you see, your main concerns and issues going forward in the long term when it comes to travel and leisure and these tariff uncertainties?
Yep, I think the boycott is just short-term noise, but my bigger worry over the longer term is that if we have a trade war going on, if there's a real tariffs imposed on Canadian goods and companies, that would be a big impact on our economy, and people would cut their spend. And when you cut the spend, what would you cut? You're likely to cut travel expenditure, because it is pretty easy for you to cut this trip. You might go to the US or international trip every year before. You might be thinking about it, rethink it. So that would be the big impact.
So if Canadians aren't traveling so much to the US, are there other places that they're going? Where are they traveling to then?
Yeah, some of them will stay in Canada and do a road trip instead, or a domestic flight. Some of them would travel to Mexico. Some of them already canceled their US trips. And some of them have not booked any trip yet, and probably would be less likely to book it.
Okay, interesting. So travel and leisure might be looking different as, the political noise grows and tariff uncertainty continues. KY, thank you so much for your insights. I appreciate it.
Yep, no problem. My pleasure.
So it's clear that President Trump has pushed the reset button on the Canada-US relationship, and Canada is now embroiled in a trade war it never wanted. The Conference Board of Canada recently examined how Canada will need to rethink how we engage with the US and the rest of the world. Pedro Antunes, chief economist at the Conference Board of Canada, joined us recently to discuss their Canada in a Changing World series, sitting down with host Pamela Ritchie. Here are some excerpts from that discussion.
There are some, dark shadows over the Canadian economy, lots of uncertainty. That said, there are some bright lights that may not be affected by the tariff story. I wonder if we can just begin there. What do you see as being maybe a safe harbor?
Well, it's not, I think it's in some ways very self-evident. And the point I'd like to make, and I'd like to encourage people to think about, is that Canada is not really a manufacturing economy anymore. We're very threatened by these tariffs on the manufacturing side of the economy, and certainly on the resource side as well. And I know we're going to get into some of that, but where we have had success is on the knowledge side of the economy. These are professional, scientific, technical service jobs. And here I'm talking private sector, where we've done extremely well, especially since 2015. And through the pandemic, we've seen phenomenal growth in that segment. In fact, growth in employment in professional, scientific, technical services has outpaced Private sector employment, 4-to-1, 4% growth a year versus 1% growth in the rest of the private sector. We've had success at exporting these services. These are essentially service sector exports, and they're barely mentioned or noticed by the Trump administration. It's very, very focused on the good side of the economy, of trade, that balance, or how should I say, that trade deficit that President Trump keeps alluding to, is excluding the services. And I think this is where Canada has done remarkably well. We've seen very strong growth in services sector exports, and these are things like financial services or engineering services or software development, these kinds of things. The other piece of good news is that we've had for a long time lagging productivity in Canada. And if we focus on this segment of the economy, this is where I think adopting technologies like AI, cloud-based technologies, will help us kind of accelerate productivity in these segments. So I'm very hopeful, at least with respect to these pieces, for the future, even as we see this kind of looming, how should I say, crisis on the horizon with our relationship with the U.S.
So let's go into, that sounds like an area, many areas actually, that we can focus on. And then what else can we do to sort of get our economy ready? I'm thinking of the interprovincial trade that looks like it is going to finally make some room for trade across provinces. That's one thing to get ready for. Maybe there's a tax side of things. Tell us a little bit about how we can get ready in Canada for this. I mean, even if they aren't imposed.
Well, I got to say, Pamela, you're perhaps a little more positive about success on that front than I might be. Maybe because I've lived through it for such a long time. We've been talking about interprovincial trade barriers. We've been talking about diversifying trade for a long time at the conference board, and myself involved in some of those research projects. And we've not seen a lot of success. And shame on us, really, for not taking more action on these things earlier, especially on interprovincial trade. So now we're kind of pushed into a wall, and we have challenges with trade south of the border, our biggest trade partner, and we're finally looking inward and saying, oh my gosh, why haven't we done more about opening up essentially a common market within Canada that would allow for competition, that would allow for specific firms or certain firms to get bigger and more productive and more competitive on not only within Canada, but on a global stage. It's just it would have been something we should have addressed a long time ago. But maybe this is another piece of good news, if you like to take it that way. We're finally seeing a resurgence of this issue, and the way that or what we call non-tariff barriers, the way these things work are essentially they're regulatory requirements that each province might have on essentially trucking, transportation, on any slew of how should I say, of regulations around products or services, or around qualifications of workers. And so what we're talking about now, or what is the potential quick solution, is, again, something we've been talking about for a long time. Australia adopted this many years ago, and that is mutual recognition. And that is to say that, okay, well, if a certain standard in, for example, truck transportation, weights, et cetera, if a certain standard is good enough in one province, then that'll be good enough for other provinces. We don't necessarily have to go back to the drawing board and realign all the regulations. So there's hope. I do think we'll probably see some gains being made in some areas, in some industries. I'm hopeful that we will tackle the issue of mobility of labor to recognize credentials and across very many different occupations. And in fact, we have mutual recognition agreements internationally with some countries. This is why South Korea is able to bring in workers to build a battery plant in Windsor, for example. So let's hope that we can do more on that front. There's other issues, of course. We're talking about retaliatory tariffs on Kentucky bourbon, for example. But we also need to open up essentially the ability of Canadian consumers to buy essentially products from across Canada. So there's a lot of things that we can do there.
Is there a final message that you'd like to leave everyone with today?
Well, I've been wrong in the past on the politics. I do my best here, and I try to understand what drives the policy decisions south of the border, and I would just reflect and think about again what happened back in the first time that President Trump was in power, that we saw all of these threats around dissolving NAFTA, for example. And again, I go back to the intent of that, which was really, I think, to move investment without really doing anything. Because once we renegotiated NAFTA and we've essentially landed on CUSMA, it is in fact very much the same deal. And President Trump at the time said it was the best deal ever. We may hear differently in 2026 when it's time to renegotiate that again. But essentially, in the end, there wasn't really these dramatic measures put in place. We didn't dissolve our free trade agreement, but it did have the success intended, which was to create that uncertainty and move investment. So I would hope that what we're seeing again this time around is that similar pattern. This time around, it's more around threats of tariffs that are causing this anxiety. Certainly, we're jumping at every time we get an announcement on something, a new tariff that's coming. Let's just take a breath and let's wait and see what the policies are, and then we'll deal with what we can at the time. But hopefully, again, this is more of a threat. This is more to create that anxiety to move the investment decision without really imposing these kinds of very hurtful, damaging to the economy kind of tariffs to both economies. Canada, the US, and in fact, the world economy. So that's the hopeful message I have.
Well, I hope you enjoyed that conversation. Now, those were segments from a 30-minute interview, which you can find as a Fidelity Connects video podcast, available on YouTube, Spotify, Apple Podcasts, and more. And as always, for more from us, please keep an eye on Fidelity Canada's LinkedIn, YouTube, or Instagram. So thanks for watching today, and I hope you'll join us again on The Upside. Tomorrow, and every Wednesday, we feature Invested in Wellness with Jesse Serafian, a series focused on elevating your well-being. Thursday, we continue discussing the big market topics, including going beyond tariffs, where to find investment opportunities, and avoid traps in 2025. With looming US tariffs on Canada and other headlines, investing in the markets can feel scary, but it doesn't have to be. We hope you'll join us for more insightful content, and remember, working with a financial advisor is the best investment you can make. Thank you again for tuning in. I'm Kyle Sharapata.